Thank you for joining our webinar today. My name is Ike Emehelu. I'm a partner at Aiken Gump, Strauss Hauenfeld LLP, and I'm one of our co-leaders of our projects on energy transition practice. I'm delighted to have the Brain Trust here to talk about the energy sector and what's the outlook for the energy sector in the light of the recent elections. Leading our conversations today will be former U.S. Representative Kevin Brady. Chairman Brady represented the 8th Congressional District of Texas for more than 25 years. He's the former chair of the House Ways and Means Committee, the Joint Economic Committee, and the Joint Committee on Taxation. He advises clients on a range of public policy and government relations issues with a special focus on tax, energy, and trade matters. Joining him will be Shariff Barakat. Shariff is a partner in our Washington office. He represents clients involved in the acquisition, development, and financing of power generation and infrastructure assets, with a particular focus on tax equity financing. Next, we have Emily Mallen. Emily is our partner in our Washington office, and she counsels clients in the natural gas, oil, and products pipeline industries. She advises them on federal regulatory, litigation, and transactional matters. Next is Ryan Thompson. Ryan is a senior advisor in our Houston office. He's a former U.S. Senate Chief of Staff and has more than 20 years of experience providing political counsel and strategy, including on energy and energy transition issues. Next is Chris Treanor. Chris is a partner in our Washington office. Chris also has nearly 2 decades of experience working on domestic and international energy, climate, and environmental policies on behalf of clients before federal agencies and the U.S. Congress. And last but not the least is Wes Williams. Wes is co-head of Aiken's energy practice and a partner in our Dallas office. He has more than 20 years of experience structuring transactions across the energy sector, with a particular emphasis on upstream and midstream transactions. This webinar is very popular. We have more than 1,000 people registered. We'll try to get to all your questions, and if we are unable to get to your questions, we'll send out, the webinar is being recorded, and we'll send out the video after this. But let's start with Chairman Brady. Chairman Brady, can you give us your perspective on the elections? What energy issues do you think resonated with voters?
Yeah, thank you, Ike, for having me. So, it's clear in the post-election polling that economic voters broke hard for the president and turned out to be a very strong part of his electoral win. Most of that related to inflation. There's no more direct correlation between higher energy prices and lower presidential approval ratings than this issue. And I think the combination of higher fuel and utility prices combined with what was seen as a hostility to more production of U.S. Traditional energy sources, plus a strong focus and a priority on climate change. I think the 3 of those elements together brought energy and the price and the production of energy made that, I think, an important electoral issue.
Ike, you're on mute, but I'll jump in for a second here if I can piggyback on Chairman Brady's comments, because I think one of the most interesting takeaways and disclose that I come about this from the Democratic perspective, which is that, much like ethanol, opposition to ethanol was a quick way to defeat in any caucus in Iowa where you're running for president. I think we now see an emerging dynamic in Pennsylvania where, being a Democrat looking to win statewide, you need to be supportive of natural gas. And I think this is a very significant change in terms of the makeup in Washington, D.C. of where pro-gas Democrats and Republicans reside. We've always talked about, the Texas Democrats being supportive of oil and natural gas production, but I think natural gas is pretty well established as a cultural touch point in Pennsylvania a state that will see, a flip from blue to red and red to blue and back and forth. And so it will sort of expand the political dynamics in Washington in terms of the situation or the circumstances surrounding support for natural gas in particular.
Okay. I'll go next to Shariff Barakat with the most popular question everyone is asking, which is, what do you foresee to be the potential impact of the Inflation Reduction Act?
Well, I think there's really a couple elements to it. With such a kind of broad victory, right, for the Republicans, there's a lot of levers to pull. And so, Chris and Chairman Brady, they can talk about sort of the political aspects, right? How Congress will impact or, think about things, what might get attacked. There's the whole priority list of EVs and which credits may or may not be at risk. But there's also a large impact that can happen through the agencies and through the administration. And so I always, I like to think of the IRA like a memorandum of understanding, and like any MOU, there's a lot to be done after it's signed and executed, and that's being done by Treasury and Department of Energy and other aspects of the administration. And so there's an incredible amount of public policy that's running through those agencies, and that could very well change, right? Some of the agenda and some of the priorities, some of the graces, some of the relaxing of the complexity that's been done through agency rulemaking, both at the regulatory and sub-regulatory level, that's all up for kind of debate now, or up for change. And so I think, we have to kind of be realistic that some of that will change, some of it from the guidance that hasn't been promulgated yet on the clean fuels tax credits, for example, under 45Z, some that already has, and that's been in proposed form, like 45V for hydrogen. And some of it that's been done in notices, like domestic content and the framework for that, and how you measure that, and how you quantify that, how you do the cost accounting. So I think it's, you have to expect some change there. How that's going to change and which direction it's going to go is still, I think, it's a little early to tell.
Okay. So let's go back to Chairman Brady. In terms of the process, I think there's been a lot of conversations about reconciliation as maybe the likely path. Can you maybe give us an insight on how reconciliation works and how it might impact the IRA?
Yeah, so before I do that, let me comment a bit on the IRA. I think to Shariff's point here, I think I would look at the IRA not as a either or, it's in or it's out, repealed or kept in place. It's a spectrum here, because I think there will be Republican support for certain provisions. And I think the House Republicans in their debt ceiling bill, sort of laid out where they were going, which was support for carbon capture type provisions and ag biofuels types, at the times targeting, offshore wind and EV credits. All of which the IRA, again, has exploded in cost. And so, those seem to be the outer ends. But I think there'll be a lot of debate and discussion among Republicans and the White House on the advanced manufacturing, hydrogen, a number of these provisions. So I think it's a jump ball on a number of those areas as well. I had thought prior to the election that the provisions, the bonus provisions within the credits dealing with prevailing wage and apprenticeships, union apprenticeships, they're very generous. I assume they would be, a target for pay for tax cuts. But with the president, leaning very heavily into the labor unions in that area, I think that might be moderated, going forward. So I think of the IRA as sort of a spectrum of issues, all of which will be, I think, probably debated individually there, Ike. And so on reconciliation, be really quick here. So reconciliation is a process. It's the runway upon which you land major bills such as tax reform, and it will be used for the TCJA and the tax provisions, certainly. It's a difficult process. It starts very early, where Congress and the White House have to get on the same page about the shape of that package, the design of it, what will be going in there, and what will constitute deficit reduction or other spending cuts within that. And it also reveals not just the size and the design, but the timing of how they'll move forward on this provision. It's a challenge. I know in tax reform, even with pretty decent margin in the House, it was difficult to get everyone on the same page. A thinner majority, as Speaker Pelosi would tell you, requires even more work, to pull everyone together, because the bottom line is Republicans, House, Senate, and the White House have to be nearly unanimous in their agreement on what will be in that package. It's the first and the most important step in the new session.
If I can add, I think, to Chairman Brady's point on budget reconciliation, this is how we did the IRA previously. This is how we did TCJA, the 2017 Trump tax cuts. And so, we've done this a couple times before. Last time we had to wait for the Georgia Senate results, and so they got started in January. They're getting started right now amongst the new leadership for the GOP, and so they'll hit the ground running this coming year. But it would be very hard to imagine that they can succeed in their plans to complete the process within the first 100 days. There is a process you have to go through with the parliamentarian rulings, deciding what's within the special rules set up for budget reconciliation. As a reminder, this does away with the filibuster, and so only 51 votes are needed. So this is a purely partisan exercise, and Democrats will not be needed to be part of it. As people are assessing the risk of their investments in the IRA, it's important to appreciate that the IRA was done through budget reconciliation, and the IRA can be undone through budget reconciliation. I share the chairman's perspective that this is a spectrum. It's probably highly unlikely that the entire IRA is repealed, but I do think it's important for our clients and observers to understand that the resistance to a full repeal will come from Republicans who feel that there have been benefits accrued in their district to some of these investments and tax credits, or others who feel that there are provisions of the IRA that are important to keep. But I'll just say that at the end of the day, there are 17 Republicans that sent a letter to Speaker Johnson suggesting that they should not be taking a sledgehammer to the IRA. But to a person, it will be incredibly difficult should President Trump decide that the first 100 days is the deadline, and it will be done on the first 100 days, and X individual Republican congressman is standing in the way from that happening. I don't think that is a pressure point that they can successfully resist. So I mentioned that only by way of stating that there is at least some risk of a full repeal, but agree with most observers that it's not likely to be the case, and they will take the scalpel rather than the sledgehammer approach to this thing. And then the second piece of this, I'll just note, because the audience we're talking to, is that I think, because this process for budget reconciliation will take some time, and I would expect it will be months worth of time, permitting reform will be a secondary priority as tax cuts, IRA repeal, tax reform takes the priority. And so there'll be needed a great deal of effort to make sure that the momentum and support for permitting reform continues to exist for the oil and gas industry, because of course it's an unprecedented opportunity with a Republican sweep. But nonetheless, permitting reform, unless it's done through fees, taxes, or otherwise, cannot really be accomplished. You can't amend NEPA or the Clean Water Act or other provisions through the budget reconciliation process. And so there will still need to be a sufficient number of Democrats joining Republicans to overcome a filibuster, should there be a desire to pass comprehensive permitting reform.
To a quick point Chris has made on timing, for Republicans, there was a sense in 2017, after all that pent-up demand for new policy, after President Obama had been in office for 8 years, and there was a realization that a lot of policy can't move through reconciliation. So the House has spent a lot of time this year sort of setting and managing expectations about what can fit into that package and what cannot. They also feel like in 2017, really Republicans squandered the first 6 or 7 months, focused completely on repeal and replace, which ultimately failed. This time, I think both the administration and congressional Republicans want to make much better use of those initial months in office. The challenge is, and we learned this, it's hard to stand up an entire administration in that first 100 days. It can be a challenge as you're doing reconciliation, putting these packages together and having those conversations with those committee chairs and policy leaders of what can and cannot be. And so it is an early and a real challenge.
And just related to that, Chairman Brady, the TCJA probably needs to be extended. Like, how will an extension of those tax cuts look like, and how do you see it being paid for? Is there an alternative to using IRA funds, essentially?
Yeah, so a couple thoughts. I think the very first discussions that on TCJA have already started with the incoming administration. Certainly, it's an opportunity to make permanent or long-term extensions in a number of the key provisions, such as the middle-class tax cuts, the new small business, 20% small business pass-through deduction, the child tax credit, the extension, the restoration of the 3 business provisions. I think those are common ground early on, but there's also an opportunity to improve TCJA. A lot's changed in 7 years. Super aggressiveness of China, AI, just the economy largely. It's an opportunity for lawmakers, and I think they'll take it to improve upon, build upon, especially in areas like international tax provisions. I think that'll be a big part of it. Plus, you will work hard in Congress to accommodate the president's campaign proposals. This is a president who knows what he promises on the campaign trail and wants, I can tell you from firsthand experience, he wants some action in your committee on those proposals. In this case, the 4 or 5 that he's put forth are very expensive proposals, and so it's natural to have conversations about how you accommodate the president's priorities along with the extension of TCJA. All that adds up to considerable revenue loss. The question is really, how much of that extension or permanence is paid for, and how they can be looking at. If you recall, and I'll be really brief, we paid for more than 70% of the tax cuts on the day the president signed it through reforms within the tax code that helped us pay down the rates, lower the rates, and then pay for growth. In fact, corporations paid for more than 80% of the corporate tax reduction. So that's $4 trillion that was in the reform bucket to pay for it. In this case, the costs will be well above $4.5 trillion, plus what is done to accommodate President Trump's priorities. They will be looking at, I think, a number of buckets, none of which are anywhere near a conclusion. It could be, looking further for reforms within the tax code, could be spending cuts, could be removing improper payments. It could be tariffs, as the president's proposed. It could be hope for revenue from more energy production. I don't think they're anywhere close to deciding that, but there will be a lot of provisions in the mix, and some of those could include tax provisions today. So if I were, from my perspective, having helped make those decisions, I would not be complacent at all whether it's the corporate rate, the business rates, the expensing and investment rates. I would stay very much on top of those tax provisions going forward.
Mhm. So the CBO's Congressional Budget Office scoring for the IRA has increased. Do we have a sense if the IRA is looked at to pay for, TCJA, whether it's the initial scoring or the new scoring or subsequent scoring that will be used?
The short answer is yes. It is being targeted to help offset the cost of extending the Tax Cuts and Jobs Act. I think the higher score we see likely in January from CBO will sort of tell you, how big, that cost is. And so there is actually here an avenue, sort of a common ground here where, policy for Republicans, none of whom voted for this, will be a big driver of their actions. So will the revenue from it. When you have a provision that has grown dramatically in cost, it actually creates an opportunity to keep common ground provisions in place, but carving back either eligibility, out years, future spending, all that. So there's actually a way to sort of bridge the gap in a bill like that.
And Shariff and Chris, outside the reconciliation process, what would you anticipate to be potential day one actions, whether executive orders affecting the energy industry?
Happy to jump in. Yeah, I would expect that, there'll be a number of priorities planned for the Trump administration, for the president to announce on day one, including likely leaving the Paris Agreement. We've recently seen ExxonMobil CEO Darren Woods and others suggest that the United States should not be leaving the Paris Agreement, but I would imagine that would be a difficult thing to talk President Trump out of doing. I expect that there will be executive orders ready to go to open up offshore and federal lands for oil and gas leasing, development, and certainly a rollback of many of the EOs that the Biden administration has carried out on the environmental justice side and climate side, including, the California waiver for their zero emission vehicle standards and other aspects. So it'll be a long list of day one executive orders, I would think, or at least week one executive orders for President Trump, beginning with repealing many of the EOs already put in place by President Biden.
Thank you. And Shariff, with all this uncertainty, practitioners often have to deal with change of law risk. Can you maybe, give us an insight as to what you're seeing and how people are addressing change of law risk in their transaction documents?
Yeah, I mean, so you kind of hit on, my world is about the transactions, and the transactions haven't stopped, right? So everything that was started over the last year, that we're in the middle of closing, that we're signing up to start next year, I'd say the most contentious issue, the most negotiated point, the most focused on point over the last year has been change in law risk and how that gets allocated. And we have to think about it even more specifically, but what people are really doing, right? The world of tax credits, right? Now that you can trade tax credits, you can buy and sell tax credits, is you have to figure out who bears that risk. And there's the whole world of insurance around this, and how does insurance look at the risk? How do the sellers look at the risk? How do you allocate the risk? I think what we've generally seen be the kind of cutoff point is the filing of a tax return that has these credits. I think there is a generally accepted view that once you file a tax return and you claim these credits and you get the economic benefit, that it is much easier to allocate change in law risk after that point. And what happens until that point is a little bit up for debate, right? So people who are transacting on 2024 tax credits, you're not filing that tax return until sometime between March or April and September of next year. And so there's a period of time that gives the administration some time to do things. And there are instances of, I call them intra-year retroactive tax law changes that are negative. That has happened before, and it has been challenged in court and it has been upheld. So those, that is a real risk that people have to focus on, but we still see deals going forward with sellers generally bearing that risk, at least through the filing of the tax return. And I think the real interesting one that we're going to have to figure out now is how to define what a proposed change in tax law looks like. What are the triggers when something hasn't been fully enacted or memorialized in a regulation or piece of IRS guidance? Without getting too far into the weeds, there's just rails built into the system around how far you can kind of kick the can down the road to decide, are we going to say that's likely to become law or not, and change our transaction because of it.
Thank you. Let's bring in Emily Mallen. Maybe talk about FERC, the Federal Energy Regulatory Commission. How do you see what's the current composition and what would you anticipate changing?
Yeah, thanks for that question. It's an interesting time at FERC. For the first time in years, the commission has 5 sitting commissioners, which is a full complement for that agency. Typically, you have the president's party gets 3 votes and the minority party gets 2, with the chairman being held by the president's party. Now, what's interesting here is that we have 3 Democrats and 2 Republicans, and the next seat that's up for renewal is actually one of the Republican seats. Mark Christie's seat expires in June of 2025. So in theory, we could have a Democratic majority FERC led by a Republican chairman for a good 2 years until June of 2026, if Chairman Phillips chooses not to resign. I have mixed feelings on whether or not I think the chairman will resign. I think in the past, you might have done that as a courtesy for the president to give them the opportunity to have the majority at the agency. I don't know that anyone in the Democratic Party wants to extend any courtesy to Donald Trump, although I have heard that maybe Chairman Phillips would resign for his own personal career desires. I know sometimes it's hard to be chairman and not be chairman anymore, so that you don't get to see your policy priorities pushed forward. So it will depend whether or not there is that 3rd seat, and then how long it takes Congress to confirm that 3rd Republican. I think, given that we have a Republican majority Congress coming in, and if this is seen as a priority so that there isn't a 2-2 split, then I think we could see that seat filled fairly quickly, because you do have to be nominated by the president and confirmed by the Senate to be on FERC. In terms of the priorities, the current Chairman Phillips has been pretty pro-infrastructure. We've seen a lot of the stalemate that had been around gas pipeline development and infrastructure development. That was a marquee Chairman Glick's way of looking at the world, which was very focused on mitigating climate change. That hasn't been Chairman Phillips' priority. He's been more focused on getting consensus building and getting infrastructure built. He's had some setbacks in the courts. Most recently, there were 3 decisions that came out of the DC Circuit this summer that remanded and or vacated FERC infrastructure cases. And so I had thought that might lead the commission to rethink whether or not they were going to do something with their natural gas policy statement next year. That's, I think, dead in the water in terms of the type of policy statement change we saw in 2022 under former Chairman Glick. So I think it will depend very much on whether or not we see Chairman Phillips resign or not, and kind of the timing of when that would be. I do think, however, to Chris's point about the executive orders, the executive orders on environmental justice and climate change being an all of government concern, those are going to be repealed by President Trump, no question. And so what happens to the environmental justice officer at FERC, and how FERC is looking at environmental justice, which really has been kind of built on these executive orders. I think it'll be interesting to see where that goes in the second Trump administration.
All right. Thank you. Let's bring in Wes. So Wes, you represent a lot of strategics and investors in the midstream space. What do you think is the industry's wish list for the Trump administration, and where would you see the biggest opportunities or challenges going forward?
Yeah, thanks, Ike. I really think that whether it's midstream or upstream, anything in the traditional hydrocarbon space, that wish list is really related to deregulation. They experienced that under the prior Trump administration. I think that all indications are that that will continue under his second term. And I think that that's just something that the industry as a whole is looking for, is the removal of the shackles or the restrictions that have been placed upon the industry by the Biden administration over the last 4 years, to just sort of level the playing field on being able to, satisfy the energy needs of the country, not only from a quantitative perspective, but also to help with the reduction of inflation, as Chairman Brady was talking about earlier.
Thank you. We'll go to some audience questions that we're getting. Again, we have more than 1,000 people registered for this webinar. If you have questions, please use the Q&A function. We'll try to get to all of them during the as many as we can. So one question that's come up, and that's for Chairman Brady, is with what impact do you think the heightened focus on tariffs will have on the U.S. oil and gas sector and the energy industry generally?
So a lot depends on how they're designed and how they're imposed, or if they are a threat to reduce, incentivize other countries to come to the table, reducing trade deficits or what's viewed as unfair trade practices. So everything depends upon the design and the imposition of it. I would think certainly for the oil and gas industry, inputs into their process and production equipment costs. A big question, would an across the board tariff, apply to imported oil, which we import 8.5 million barrels from 80 some countries. Would that be excluded from that? Not known at this point. The oil and gas industry probably doesn't have to fear retaliation from other countries if these tariffs are imposed, for the obvious reason, affordable, reliable gas is crucial to Europe and the rest of the world. So probably don't have that to fear. And there's obviously the slowdown economic growth and demand that tends to accompany tariffs of significant sizes. Again, difficult to know if that's exactly the direction they go. But I think the way to think about tariffs are that there is an urgency here. A lesson learned from the past Trump administration is that unified government is fleeting, that they have effectively 2 years, not knowing the outcome of the midterms, but acting as if they have 2 years to move their entire policy agenda forward. So, I think most would expect to see fast movement on China and Mexico related to border security issues, trying to figure out which rules and tariffs could move on an accelerated basis. If you recall, they were pretty deliberative in their first term on both the steel and aluminum tariffs and the China tariffs, using the process, making it work, very deliberate that way. I think they're going to want to accelerate where they can that process. And of course, the conversation about can they impose unilateral tariffs, I think, is one they are having with a Republican Congress as we speak, including, can tariffs be included in a reconciliation bill as a way to help offset TCJA costs, and could it pass the Byrd rule in reconciliation? The short answer there is it's not clear yet. Certainly, there's not enough clarity today that President Trump's team and Ways and Means Chairman Jason Smith are having conversations about if they need to clarify that in the House rules, some of which Republicans will be taking up this week, their own rules, but that could be a package that comes to the House floor the very first day of the session. The other point, and I'll stop here, is that, could tariffs on their own pass the Byrd rule? My guess is if the way it's written, sets those tariff levels and generates those revenues directly, it's more likely to pass muster. then perhaps a Reciprocal Trade Act or some other bill that allows the president to adjust tariffs to certain levels, that might run afoul of the incidental provision, a budgetary provision that knocks a lot of things out in reconciliation. So right now, I think a lot of to be determined in this space.
Thank you. Another question that's coming from for the audience relates to 45X production tax credits. Shariff, Chris, or Chairman Brady, any thoughts on whether the 45X production tax credits may survive a scalpel approach, or does it depend on the new administration's priorities?
I think that one probably sits right there in the middle, in between the carbon capture and sequestration and the EV consumer, as the safest and the most at danger. I would think 45X is right there in the middle. President Trump, in his first term, spent a lot of time talking about onshoring of American jobs. I think that, the support for 45X can certainly be viewed within the context of U.S. competition with China for global supply chains. And so to that regard, there's a lot of reasons why I would think a Trump administration could be in favor of it. It may come down to just a priority, paying for other priorities, or whether it's something that President Trump feels is important to continue in order to continue onshoring of American jobs.
Yeah, I would agree. I would agree with that analysis. I know there are Republicans who are very interested in those provisions and in the whole advanced manufacturing segment of the IRA as well. So yeah, I think that's going to be one of those jump ball type provisions.
It's also, I'll say, like a perfect example of what can be done administratively. If you look at some of the differences between the proposed regulations and the final regulations on 45X, there are in some cases very dramatic differences between what costs get credited and accounted for, allow for certain credits. And so it's a perfect example of where the administration may be able to act without congressional input. The statute's there. You need Congress to really tweak the statute, but there's a lot underneath it in the minutia and the detailed calculations that matters.
And that's true for all the tax credits, right, Shariff?
Yeah, for many of them, but particularly I'm saying for 45X. 45X, and if you look at the preambles to the regulations, they state support this domestic industry, or this is why we are implementing this rule because of this public policy priority. And so there's room for interpretation one way or the other, like there is with many of the tax credits. But where it is this jump ball, it's a place that a Trump administration can kind of go in themselves without congressional support in many ways.
Yeah, we got a number of questions about timelines. As you can imagine, investors want to know what milestones to look for to guide investments. So the first is, in terms of timelines, if there's a repeal of the IRA, I think, Chris, you may have mentioned it earlier, what will the timeline be for that, for something like that?
At some point in this coming year. I mean, the budget reconciliation process would need to be completed. Correct me if I'm wrong here, Chairman Brady, but by the end of the fiscal year, so September 31st, there could be a second bite at the apple to actually do two budget reconciliations in 1 year if they can get it together. Something Democrats aspired to and couldn't come close to pulling off, but it is possible. So I would expect, the Trump administration or some Trump officials have signaled that they want to do this IRA and tax cuts package within the first 100 days. I've commented that I think that that's overly ambitious and difficult. Legislating is hard, especially when you have a narrow majority in the House of Representatives, like the Republicans look like they're going to have. And so I think this is probably closer to a, 3, 6, 9 month exercise rather than 100-day exercise. But that's there's a lot of personalities and policy priorities to consider that goes into informing that timeline.
Yeah, I would agree with that. The ultimate answer is by the end of the year, is it? And Republicans would like to accelerate that dramatically if they can.
Shariff, maybe something you mentioned earlier, which is the intra-year retroactive rule changes that I think a number of people are not aware of. So given that there's a risk of the IRA, potentially being amended or repealed by the end of the year, can you maybe explain how an intra-year retroactive rule change potentially works?
Yeah, I mean, it's not so much like a different mechanic than call it an inter-year or going to prior years, but it's just the examples. So, I mean, within the tax credit space in particular, there have been a number of times that Congress has retroactively improved the eligibility of credits. I'm thinking particularly, I think it was 2015, I'm remembering, on like December 10th, they passed a law that made wind farms eligible for all of 2015, right? And so it went back, and I think even with the IRA, you could see it a little bit. The 26% ITC went to 30% ITC for maybe period of 22, but negative ones. Are there examples of that? There are a few examples. I know there was one in the Clinton administration dealing with the estate tax, and that I can't remember the exact year it occurred, but they tweaked the estate tax in a negative way back to the beginning of the year. There's another example in the 70s. I don't exactly remember what that one was, with the tax rate increase, I think it was. But there have been some examples of within the same tax year making changes and it being effective to the beginning of the tax year. That's just to say those are some examples, not that there's a magical rule that that works and something else doesn't, or that's the way to do it.
Emily, a question for you on a different topic. Just generally, in terms of the interconnection system, any comments on what, if any, changes that you would anticipate?
I'm sorry, you mean interconnection to the
Oh,
transmission
yeah,
grid?
transmission network. Yep, thank you.
Well, I mean, I think FERC has been pretty clear that they're very interested in looking at viable projects and making sure that viable projects get through. I don't think that's going to change too much. And I think there's not it's not a super partisan issue from where I sit. I think what the more partisan issue at FERC, if we see a change in leadership, well, we know we're going to see a change in leadership, but if we see a change in composition, is more around the order number 1920 transmission planning. And because Commissioner Christie, who may be aligned to be the next chairman of the agency, had a very scathing dissent in that decision in terms of how FERC wants to work with the states to plan, transmission, and very concerned that FERC is more interested in meeting the priorities of states that wanted to have more climate friendly or climate change friendly approaches versus others, and having to socialize those costs. So the compliance filings for that order aren't due until next year, and it would be messy to unwind it, but FERC has done messy things, so I think that's one place to look. I think what's more interesting, honestly, which kind of blew my mind yesterday, was the DC Circuit's Marin Audubon Society versus FAA decision, which maybe decimated the CEQ's ability to issue rules under NEPA, and how that interplays with permitting reform. It's one of these things where now that with the fall of Chevron and the Loper-Bright decision, we've seen some pretty interesting decisions come out of the DC Circuit that seem to be at odds with one another, just depending on the panel that you get. This was not an issue that was briefed by either party, that you should rethink whether CEQ has the statutory authority to implement any NEPA regs at all. And what's interesting now is that it'll be up to the Trump DOJ potentially to decide whether or not to appeal that ruling en banc. Whereas the Biden administration, we know, would appeal it, seek rehearing en banc. We don't know what Trump administration would do there, but it does throw the whole permitting reform efforts, I think, Chris, into a little bit of a disarray in terms of how we unpack what that decision means and whether that decision will stand, and how that interacts with another case that's in front of the Supreme Court this term, which is the 7-county infrastructure case. And I know that's not responding to your first question, Ike. I just thought it was important to mention this case because it's really probably the most consequential NEPA decision, certainly since I started practicing law.
Yeah, no, that's actually helpful, and we appreciate the audience member who also posed that question. So you targeted it as well. So thank
I
you.
was going to mention it anyway, but
Yeah.
yeah, I know there's some folks in the audience who are very
Yeah.
interested in what that case is going to mean.
So thank you.
I'll also note it's interesting because this goes to another question that was asked by the audience, but to the extent that CEQ, right, a White House administrative, quasi agency, I guess we could call it, because it's inside the White House, may be quite similar in its authority to that of DOGE, the Department of Government Efficiency that Elon Musk will be co-leading. Creating a bureaucracy to fight bureaucracy. Well, an
The
interesting
coffee table book about coffee tables, Chris.
Yeah, I mean, to create rulemaking authority, you need Congress to be involved, and you certainly cannot stand up a new agency through budget reconciliation. I wouldn't think. I feel fairly confident in saying that, and so I do think that the DC Circuit decision on CEQ and its authority is very relevant to the future authority of the Department of Government Efficiency.
There are a number of questions that fall into the category of what should we do now? If somebody has a clean energy project ready to launch, should it move forward or should it wait? Should people channel investments into the ITC versus PTCs? So generally speaking, for investors looking to make investment decisions now, what would you, and maybe, Shariff addressed it with change of law protections, but what would you say to those investors, and how should people think about the upcoming change in administration? Shariff, do you want to repeat your change in law comment?
Well, I think, yeah, I can speak to change in law generally, which is that can be allocated contractually, right? And so many of the clean energy projects, right, fundamentally, these are project finance deals, and you're attracting a capital stack that's a mix of debt and equity, and how the change of law risk is allocated amongst those capital providers and the sponsors or borrowers, that can be negotiated, and you can proceed with projects with a negotiated framework. And we're seeing that happen. I think, part of, what I'd read into that question is just people saying, well, what should we do, right? If we're trying to position ourselves best in order to call it survive, right? To earn or have some sort of vesting, maybe let's call it, of a benefit. And I think, much of the clean energy framework is the timing for qualification revolves around beginning of construction and starting work on a project. And there's the whole framework about how to do that, which is, we could talk about, but the statutes say you get this subsidy, this tax credit, if you begin construction on something. And I think if you couple that with what I've always thought of or thought of as a rule of thumb with the Republican Party, is they don't like to create uncertainty for business, and they don't like to pull the rug out. I think and I'd be interested to get some commentary from the rest of the panel here, right? I think a lot of what people are thinking to do in our industry is to begin construction on stuff, to try and actually, start building something or embark on some sort of strategy. And maybe query for the group here whether that's likely, either more from a political perspective, are Republicans more likely to say, hey, we're not going to pull the rug out from those projects that have genuinely started?
As
Chris,
a Democrat, I think I might pass on this response.
Yeah.
So I will do my best. So my first thought is, one, get with Aiken now, because we have a very strong bipartisan lobby team that's staying on top of every one of these provisions, and our goal isn't just to see what happens, but to help shape it the right direction. We can help you do that. That's my first thought. Secondly, Republicans by and large don't like to interrupt projects once they've begun, but I would say you're pretty close to that point already, in the sense that moving forward with this much uncertainty, I'm not sure protects you necessarily. If there's going to be significant changes in a credit that affects you, that's important to your project. Again, another reason to have these conversations with us, because we're having them with the or at least our lobby team with the lawmakers as they go forward. There's just so much uncertainty right now in this space. Well, I would want that. I would want more clarity before making that call.
And this is probably why it's important to like look, and I will encourage everybody to look at your change of law definition. We went through this, various administrations, and sometimes it would say a public statement by the president, and sometimes you will have to understand that just a public statement may not be enough. You might need congressional action. So we'll encourage people to, take another look at the change of law protections that they have in documents. Another question from the audience was, do we see private equity investors or infrastructure investors changing the focus of their capital away from the clean energy sector to something else? I think my initial response is, in addition, obviously, to the IRA, there are other reasons why people are investing in clean energy. But, Chris or Shariff, do you want to address that first?
Well, no, I agree. I think one thing I always tell people is like, the IRA and all these subsidies, they're great. They're very important to these projects, but this is a secular trend, really, the energy transition. And whether the subsidies are coming from the federal government in the form of tax credits, or they get moved down to more local levels, or it's taken on by the private sector, right? You see the big tech companies willing to pay for that green power and everything. That's just an example. There are a lot of kind of factors coming together to drive this. And so I don't see a slowdown, and especially in the last, call it month or even week, right? As the results here from the election have materialized, as I kind of started out here, we are still going full steam ahead on everything that we're doing. And I think there's a real belief that this is still an attractive area for capital to be deployed to.
Yeah, and I'll just add the political context that I think there should be some comfort taken in the fact that the corporate commitments that have been made will need to be lived up to. We've seen cycles before where there was strong climate advocacy in Washington and a change in administration where there's no longer a welcoming environment for regulation, tax credits, or climate policies here in DC. The advocacy and the massive amounts of funding into climate advocacy don't dry up or go away. They shift from federal policies to state regional policies, voluntary markets, and investor, activist investing, shareholder lawsuit strategies, things that will hold corporations accountable for the climate commitments and sustainability commitments that they've already made. In one area, we already see, data centers and AI driving significant increases in power demand. Well, those are, being driven by just a handful of companies, and each of those companies has pretty strong climate, clean energy, and sustainability commitments as publicly traded companies and probably more relevant as multinational companies operating many regions around the world. And so those commitments that they've already made, they'll need to live up to without exposing themselves to political and potential civil liabilities around the world.
Wes, a question for you, which we haven't really discussed, the LNG market and oil and gas M&A. What's your outlook going forward? And the specific question is, what do you think will be the impact of antitrust regulation on oil and gas M&A?
So I think what we've seen over the course of the last 4 years, Ike, is probably what we would call an outsized focus on antitrust regulation or oversight in the oil and gas space, especially when it comes to M&A in the space. I think we've seen a number of examples of energy transactions in the hydrocarbon space getting slowed down, or second requests from the FTC and DOJ, which looked at a number of factors. And I think that what we're anticipating under a Trump administration is not necessarily any change in sort of the baseline antitrust review that oil and gas deals will receive, but probably they won't receive the level of outsized scrutiny that we've seen over the course of the last few years. So hopefully that makes A&D and M&A in the oil and gas space a little bit more efficient and can ramp up sort of deal flow for the space.
Thank you. Another question, if anyone's able to take it, is any thoughts on the campaign promise of a 15% tax rate for companies producing in the U.S., also applying upstream?
So, you know, my sense is, one, the president wants to lock in the more competitive rates from TCJA, and Congress does as well. He'd like to go lower if they can, which is sort of the approach he took in 2017 as well, when he wanted a 15% corporate rate, and then work with us to sort of figure out what were the most pro-growth priorities that need to be funded within the legislation. So my guess is it'll take that same arc in conversation. And I think he now, with these other tax promises on overtime and Social Security and tips and all of that, it's going to have to sort of set those priorities within that whole tax cut discussion. So I think it'll be lock it in today and look for ways to make it lower if possible.
Right. And Shariff, President Biden is still in power for like 2 more months, maybe. Are there Treasury guidelines that have not yet been released that may be meaningful to, frankly, rush out?
Yeah, I mean, what we've heard is that there will be rulemaking coming out through the end of the current administration. Some of the projects that were started will be, final regulations will be published or other guidance will be published. So, yes, the short answer is yes, there will be more guidance coming out of the current administration.
I'll add, since you just asked Wes about the LNG, that we do expect that DOE will release the LNG study and open it for a 60-day comment period as soon as this week.
And do you just want to explain the impact of that, Chris?
Yeah, sure. So, as you recall, President Biden in January of last year put a pause on approval of new export authorizations to non-free trade agreement companies. I think it certainly was regrettable from a political standpoint, at least the way it played in Pennsylvania. But there'll be plenty of time to rehash how that decision played out. But nonetheless, it'll be a day one priority for President Trump to lift that pause. And, it's included in the Manchin-Barrasso permitting reform legislation. So if that were to take off, there's potential that it could be lifted by statute through that. I think that's, to be determined whether permitting reform in the lame duck is feasible or not. But regardless, on day one, if it's not done through legislation this year, President Trump will lift the LNG pause, and that should open up continued flows into investments into new projects and applications for new export terminals and authorizations through DOE. Yeah.
Thank you. And I think with that, we've come to the end of our Look at It time. I want to thank all the panelists for your insights, and every participant, thanks for joining Aiken for this presentation. This was recorded, and we will share it eventually with all participants. Thank you all.